Welcome to Finance and Accounting Tutorials. My name is Peter and I will be your host in this particular tutorial. Today we are going to look at the cash flow statement. So a cash flow statement is a statement which summarizes the sources of cash and how that cash is used. That is, the cash inflows and the cash outflows, how money comes into an organization and how that money is spent or how it gets out of the organization. Now the cash flow statement, this is the format of the cash flow statement, the indirect method. So we find that the cash flow statement is divided into three major sections. We have the first section, which is the cash flow from operational activities. Then we have the second section, the cash flow from investing activities. And as you will see in the next slide, we have the third section, which is the cash flow from financing activities. Under the cash flow from operational activities, we start by getting the net profit before taxation and extraordinary items. Under this, we start by taking the change in the net profit. To get the change in the net profit, you look at the difference in the different period that you are given. You'll be given two periods, maybe year 1 and year 2. Get the difference in the net profit. That change in the net profit, you're going to add the items that are likely to reduce the net profit. These items include the dividends paid. Dividends, remember, it's the profit that is shared to the shareholders, or there is a shareholders' earnings. Then we have transfer to reserve and loss on disposal of non-current asset. When you sell an existing asset at a lower value than it was bought, you make a loss, and that after you have subtracted the depreciation, the loss that you get, you add it here. Income tax also added back there. Then you're supposed to less those items that are likely to increase the value of the net profit, and these items include profit on disposal of non-current asset and income from investment. After subtracting that, you are supposed to add back the adjustments for depreciation. Now the next section under the cash flow from operational activities is the profit where you're supposed to add increase in current liabilities, and also you add decrease in current assets. So why do we add increase in current liabilities? Remember, a current liability, like a bank overdraft, when a bank overdraft increases, it means that the company has acquired more cash, and that cash increases the amount of our cash, and that is why we are adding it here. But if it decreases, like for example, if the bank overdraft decreases, then it means that the company has actually paid part of the bank overdraft, and therefore it reduces our cash, and that is why we are supposed to less it here. Any decrease in current liabilities, you're supposed to less. Then you're supposed to add here a decrease in current assets. Now, why do we add a decrease in current assets? A current asset like inventory or stock, when stock decreases, it means that we have sold out some stock. So when you sell out some stock, we get some cash, and that cash will increase our cash, and that's why we are adding it here. Then if there is an increase in current assets, like if the stock has increased, it means we have acquired more stock. And for us to acquire more stock, then we are going to spend cash. And when you spend cash, then you're going to decrease your cash. That is why we are subtracting. So note that if you add an increase in current liability, then you're supposed to do the opposite here. You less a decrease in the current liabilities. The same way, when you're adding a decrease in current assets, you're supposed to less an increase in current assets. Then the total there will give you the net cash from operating activities. Then below there, in the second section, we have the cash flow from investing activities. In this section, you're supposed to add any decrease in non-current assets. Why do we add this? And non-current assets are items like buildings, machinery, and land. Now, when you reduce your machinery, it means that you have sold out some machinery. When you sell out, you're going to acquire some cash, and that is why we are adding it here, because it will increase our amount of cash. Then you're supposed to less any increase in non-current assets. If, for example, the number of vehicles have increased in a particular year, it means that the firm has spent the cash in buying the motor vehicles, and therefore it reduces the amount of cash. When the amount of cash is reduced, then that is why we are lessing an increase in non-current assets. Then the total under that will give you the net cash used on investing activities. The other section, we have the cash flow from financing activities. Here you're supposed to add any increase in non-current liabilities. A non-current liability is something like a long-term loan, like a 5-year loan. That is a long-term, that is a non-current liability. So when a non-current liability increases, it means we are acquiring some cash. Like, for example, if the company acquires a loan, then it means that we have acquired more cash, and that is why we are adding it here. Then we are supposed to less any decrease in non-current liabilities, because it means that if the loan has decreased in the next period, then it means that the company has paid up some amount, and that reduces our cash balance, and therefore we subtract it here. Don't forget to less the dividends. The dividends, like we said, are the shareholders' earnings. Remember, when you pay the shareholders, you are reducing the amount of cash, and that is why we are subtracting it here. Now, when you get that, the total here, you're supposed to get the net cash used in financing activities. Then when you total it up with the amounts that we got from the other two sections of the cash flow from operational activities and cash flow from investing activities, you are supposed to get the net cash decrease or increase in cash and cash equivalents. So if the figure here is negative, then it means we have a net cash decrease. If the figure here is positive, then we have a net cash increase. Then after that, you're supposed to you add the cash and cash equivalents at the beginning of the period. This includes the amount of cash is given in the statement, in the financial statements. So the cash at the beginning of the period, you put it here, and then when you add to this figure, you're supposed to get the cash at the end of the period as given in the financial statements. Now, having looked at the format of the cash flow statement, let's look at an illustration for us to understand how to put that into use. This illustration says the financial position of ABC Limited on 1st April 2001 and 31st March 2002 was as follows. So you are given the financial position of this firm ABC as at 1st of April 2001 and as at 31st of March 2002. So we have two periods, one and this period. Then we have the same way on this side. So this is our debit side and this is our credit side. Don't mind about where we have placed it. This is just an example, you understand. So when you look at this, I have added an extra column here. Now this column here, I added it for me to be able to know whether there was an increase or a decrease between the two periods. Like for example, if you look at the current liabilities, on 1st of April 2001, the current liabilities were Kenya shilling 72,000. Then on that 1st of March 2002, the current liabilities were 82,000. Now the difference between 72 and 82,000 is 10,000, which is an increase. It has moved from 72 to 82. That is an increase of 10,000, and that's why I've added here. I've put here positive 10,000. If you go to this loan from associate company of, at first, that is in 2001, they didn't have a loan, but on that 1st of March 2002, there is a loan of 40,000. It means that they have acquired a loan. of 40,000, and that is why we have that increase of 40,000. So let's look at. We also given some additional information. We are told that during the year we have dividends of 52,000 that were paid. Then you are required to prepare the cash flow statement as per the revised AS3 by indirect method. Now here we have the solution. So like we said, the cash flow statement has 3 sections. The first one, we have a cash flow from operational activities. We have 2, cash flow from investing activities, and 3, we have the cash flow from financing activities. Now let's start with the first section, the cash flow from operational activities. We start with the net profit before taxation and extraordinary items. So if you look at our items as provided in the statement of financial position, we don't have a net profit, and that's why I've put here a negative. But we have been given the capital and reserves, and if you look at them, there is a change and there is an increase of 2,000, and that's why I added it here. Then there are some dividends which have been paid of 52,000. So when you add that to give you 54,000, then you add adjustment for depreciation, which is an increase as indicated in the statement of financial position of 18,000. You add that, you get the profit from trading operations as 72,000. Then you're supposed to add any increase in current liabilities. As we have seen, the current liabilities as they have increased by 10,000. What does that mean? The increase of 10,000, it means that the company has actually acquired more current liabilities, like maybe it has acquired more goods on credit, or it has borrowed through bank overdrafts. That's a current liability. Then you add any decrease in current assets. In this case, we have stock. What has happened? Stock has decreased by 6,000. So you do what? You add that. When stock has decreased by 6,000, it means that we have sold this stock and we have received 6,000, and that's why we are adding it here. Then you less any decrease in current liabilities. In this case, we don't have a decrease in current liabilities. Then you less any increase in current assets. If you look at the debtors have increased. If the current assets have increased, what does that mean? It means that the company have sold more items on credit. When we sell stock on credit, we don't receive any money, and therefore it's like we are reducing our cash flow, and that is where we have actually deducted 6,800. So when you subtract that, you get the total here. The net cash flow from operational activities is 81,200. Now let's move to the to section B, the cash flow from investing activities. Here you are supposed to add any decrease in non-current assets, which in this case we don't have any decrease, but we have an increase in non-current assets, which you are supposed to less. Why? Because if the non-current assets are increasing, it means the company has acquired more non-current assets. And when you buy an non-current asset, it means you are using the cash that you have, which reduces our cash, and therefore we're supposed to subtract. The building in this case have increased by 10,000, and therefore means that the company has purchased more buildings. That's where we are subtracting. Purchase of land of 20,000 and purchase of machinery 30,000. So the total of the net cash used in investing activities is 60,000. Then we go to the last section, C, the cash flow from financing activities. Here you're supposed to add any increase in non-current liabilities. Why do we add increase in non-current liabilities? Like we said, non-current liabilities include long-term loans. When the loans increases, it means that the company has acquired more loan, and when you acquire more loan, it means that you have acquired more cash, and that's why we are adding it here. Now if you look at that, we have a loan from associate company which has actually been acquired in the second period, and that is 40,000. That's why we are adding it here. It has increased our cash. Then you less any decrease in non-current liabilities. When a non-current liability decreases, it means that the company has paid up the loan. And in this case, if you look at the bank loan, it has reduced with 10,000, and when it's reduced, it means the company has actually paid 10,000. It means that our cash has reduced by 10,000. That reduction, we less it there. Then don't forget to less the dividends. The dividends, remember, these are the shareholders' earnings, which we also pay, and when you pay them, you are reducing the cash. So we less 52,000, and we get the net cash used in financing activities as 22,000. When you get the totals here, we are getting negative 800, meaning we have a net decrease in cash and cash equivalents. Then you add cash and cash equivalents at the beginning of the period. Now, if you go back to the statement of financial position that we were given, the figure here, 8,000, is the amount as given on 1st of April 2001. That is the cash as it is given there, 8,000. When you add 8,000 to negative 800, you get 7,200. The 7,200 is our figure as at the end of the period. That is on that 1st March 2002. And that is how you know whether your cash flow is correct or not. These figures must be correct. It must show you the figure at the beginning and the figure at the end here. So that is the cash flow statement. I hope you have understood it, and we do appreciate for taking this moment to follow up on our tutorial. For you to get into connection with our future tutorials, kindly subscribe to our channel. It will cost you nothing. It is as simple as subscribing, so that in future, whenever we post any new tutorial, you get a notification in your email address and you're not left behind. Please keep in touch with us as we post more and more better tutorials that will enable you to understand finance and accounting concepts with ease. My name is Peter, and I'm so grateful for this great moment. Thank you.